Welcome to the Deep Dive. We crack open key corporate documents so you get the real insight without wading through hundreds of pages yourself. Today we're looking at a fascinating one, the 2010 shareholder letter from Morgan Stanley. Now, you've got to picture the scene. This letter comes out for their 75th anniversary, but it's right in the shadow of the 2008 financial crisis.
Absolutely critical context.
So our mission here is to unpack this source. How does a giant like Morgan Stanley navigate the mess of 2009? And set its strategy for 2010. We want to understand their plan and maybe more crucially, what success even looked like to them back then.
Right. And they framed 2009 very carefully a period of challenge and change. But what they really hammered home was getting back to their core values.
Oh, the values piece.
Exactly. Things like client focus, integrity, ingenuity, that old motto, first-class business in a first-class way. It was all about rebuilding trust, especially after everything that had happened.
Okay, so let's dig into that. Moving forward from all that.
Yeah.
That trauma, really. They needed a path. What was the big picture strategy?
Well, the stated goal sounds pretty straightforward. Become the top client-centered financial services firm.
Client-centered, okay.
Yeah. And they plan to win using, deep client relationships, their global reach, and being dominant in growth markets.
And they put a number on it, didn't they?
Yeah.
Aiming for the top 3 in all their key businesses. That sounds ambitious. Right after a meltdown.
It does sound bold, maybe even a bit reckless on the surface.
Was it real or just talk to rally the troops?
I think it was a bit of both. Definitely some high-level bravado, yeah. But it was backed by some massive changes they made in 2009. They called it their year of transition. And they weren't kidding. It wasn't just patching things up. It was a fundamental shift.
Right, the structural changes. Let's talk about those because they grew in some places and shrunk in others, yeah. On the growth side, they finished the Smith-Barney deal. Why was that specific joint venture so important post-crisis?
Well, Smith-Barney wasn't just about getting bigger, though it did give them, quote, the world's leading wealth management network.
Right.
The real strategic move was shifting away from that volatile trading revenue towards more stable, fee-based income from retail clients. That builds resilience.
Makes sense.
And they had a big cost-saving target, too, aiming for $1.1 billion from integrating it. By the end of 2009, they'd already found, $445 million of that.
Okay. And then there was the MUFG Alliance, Mitsubishi UFJ Financial Group. What did deepening that relationship give them?
MUFG. That was about stability and access. MUFG is Japan's biggest bank.
Right.
So by tightening that alliance and integrating their securities businesses, Morgan Stanley got much better penetration into the Japanese market with a strong local partner.
Leveraging MUFG's capital and reach on the ground.
Exactly, which is gold in that kind of risk-off environment.
And on the other side, they were slimming down, selling parts of asset management.
Correct. They sold Van Kampen and the retail side of asset management to Invesco. The idea was to let Morgan Stanley focus purely on institutional asset management, which fits better with their core clients.
Right.
And they kept a piece of the action, too, retained a 10% stake in the bigger Invesco. So they got rid of the operational complexity, but kept some potential upside.
Which brings us to TARP, paying back the Troubled Asset Relief Program funds. Huge PR win, right? 6 months, 21% return for taxpayers. Great headline.
Fantastic headline.
But was it really about confidence or just getting out from under the government's thumb? The regulatory oversight that came with that money must have been intense.
Oh, absolutely. Shedding that oversight was critical. They made sure everyone knew they paid it back fast. The goal was ditching the constraints, ditching that perception of government dependence. They needed to look like a strong, independent firm again. That 21% return line. Necessary cleanup, you could say.
Okay, so here's the puzzle you mentioned.
Yeah, the paradox.
Despite repaying TARP, despite these big strategic moves, leadership said they weren't satisfied with the 2009 financials. Why? If they did all this stuff, why did the numbers look, well, kind of bad?
It's confusing if you just look at the bottom line. The numbers do tell a weird story.
Net revenues, $23.4 billion. Okay. But income from continuing operations, only $1.1 billion. That ends up as a loss of $93 per share. How does a firm making these big pivots report a loss like that?
Right. This is where you absolutely have to understand the debt valuation adjustment.
DVA.
DVA.
Okay.
What's kind of wild here is that their net revenues got hit by $5.5 billion, a huge amount, and EPS dropped by $2.84 because Morgan Stanley's own debt got safer. The credit market liked them more.
Wait, hang on. Their earnings went down because the market thought they were less likely to default. That sounds completely backwards.
Yeah.
Am I supposed to just ignore a $5.5 billion hit because it's actually good news?
It feels totally counterintuitive, I know, but it's an accounting thing. Basically, when your debt becomes more valuable because you're seen as safer, and you hold that debt on your own books, that increase in value counts as a technical non-cash loss for that period. So leadership had to really stress, look, this is a long-term positive. It showed the market regaining confidence even though it hammered the reported earnings that year.
Okay, that context is crucial for understanding that loss figure.
Yeah.
And you saw that market confidence elsewhere, right? Their stock price jumped 85% in 2009.
Exactly. And their capital position was strong too, Tier 1 ratio of 15.3%. The underlying health was improving despite the accounting noise.
So if the credit markets were positive, where were the actual business lines showing strength? Let's look at the structure. Institutional securities.
Yeah, institutional securities was performing well, relatively speaking. They actually ranked #1 in global M&A in 2009.
In the middle of all that chaos.
Yeah.
Wow.
Yeah, that rank means real client activity, real deals happening. And they were focused on expanding what they call client flow businesses, interest rates, FX, equity derivatives, stuff that serves corporate clients day to day.
And then the big stability play. The new giant, Morgan Stanley Smith Barney.
That became an industry leader overnight. You're talking 18,000 advisors, $1.6 trillion in assets, just massive scale. And a key sign of stability, they pointed out. Turnover among their top advisors was at historic lows. The talent was staying put through the merger. That's a big deal.
And international was clicking too.
Absolutely. Those alliances, especially with MUFG and also China Investment Corporation, were paying off. In China specifically, they were #1 in M&A, #2 in equity underwriting for 2009. They were really cementing their global position.
And all this change was happening alongside a leadership transition too.
Right, a smooth one. James Gorman took over as CEO from John Mack, who stayed on as chairman, signaling continuity, stability.
Good governance at the top.
Exactly. And the whole new management team reflected that. Ruth Porat became CFO. The senior team averaged something like 25 years of experience. At a time when the whole industry was, frankly, scrambling, that depth of knowledge was a real advantage.
Okay, now for the part that really shows the impact of '08. The compensation changes.
Yeah.
How did they actually try to fix the incentive problem? The short-term thinking that contributed to the crisis.
This is where you see the biggest internal shift, I think. They did a complete overhaul. The message was clear. Pay needed to be tied to long-term results, face serious clawbacks, and be genuinely at risk. No more quick bonuses for short-term gains that might blow up later.
So for the top people, the operating committee, how much pay got deferred?
A lot. For them, the deferred portion of their year-end incentive pay shot up to 75%. 75.
Wow.
That's a huge chunk designed to make sure this year's results are actually sustainable for, at least 3 years before they fully cash out.
But how did they stop even that deferred pay from encouraging bad risks?
They beefed up the clawback rules significantly. It wasn't just if a trade lost money. Crucially, they added triggers for violating risk limits, compliance rules, or even ethics standards.
Tying paid directly to ethics and compliance. That's fun to make.
It's a big alignment shift. And they also added those at-risk performance units for senior execs.
Right. What were those?
They only paid out after 3 years if the firm hit specific targets on things like return on equity and how their stock performed compared to competitors. Again, pushing focus from just individual deals to long-term firm value.
Beyond fixing their own house, they also talked about supporting wider regulatory reform.
Yes, they were very explicit about working with policymakers. They backed specific ideas.
Likewise.
Like establishing a strong systemic risk regulator, someone who could look across the whole system, not just one bank, and stop things from getting out of hand again.
And internationally. Regulation across borders.
They pushed hard for global coordination. They didn't want regulatory arbitrage, where firms just move risky stuff to countries with weaker rules. They argued for a level playing field globally.
And finally, let's not forget the role in the actual economy picking up.
Right, they weren't just internally focused. They highlighted helping companies and governments raise over $142 billion in debt and equity that year, acting as that intermediary.
Keeping capital flowing.
And they were involved in housing stabilization, too. Their mortgage servicer, Saxon, was ranked number 4 in the Treasury's HAM-MP program, that's the Home Loan Modification Program, in early 2010. They wanted to show they were part of the solution.
So wrapping this up,
Mm-hmm.
what's the big picture from this letter? It really paints a scene of intense internal focus, right? Fitching the structure, refocusing strategy, doubling down on client relationships, all under this huge cloud of new regulation and past crisis. It's like a textbook on post-crisis adaptation.
It really is. And it echoes their founding, doesn't it? Morgan Stanley started in September 1935,
Wow.
right in the middle of the Great Depression, another period of massive challenge. The strategy described here, adapt, innovate, stick to core values. It's kind of in their DNA, or at least that's the story they tell. Build something lasting out of the wreckage.
A powerful connection.
Yeah.
Built in crisis, rebuilt in crisis. So thinking about that intense focus on changing behavior, especially with compensation, that 75% deferred pay, the ethics clawbacks, it leaves us with a thought for you, the listener. What do you think is ultimately the tougher challenge for a firm like this in the long run? Is it managing the external stuff, the unpredictable markets, the economic swings? Or is it managing the internal stuff, human behavior, making sure everyone's incentives are truly aligned year after year? Something to think about.